The headlines are screaming, a coordinated chorus of financial media panic. Warren Buffett dumps $110 billion of Apple stock. It's designed to make you click, to make you gasp, to make you think the Oracle of Omaha has finally soured on the world's most valuable company. But what if I told you that headline is a lie? Not just an exaggeration, but a deliberate piece of financial misdirection. The real story isn't about the number. The real story is about the warning. A warning so profound, so deeply embedded in the actions of Berkshire Hathaway, that it points directly to a systemic fracture, a market crash that has the year 2025 written all over it. The numbers you're being fed are part of the scam. Let's get the facts straight, because the professionals, the ones who are actually positioning themselves for the fallout, operate on facts, not on clickbait. Berkshire Hathaway did not sell $110 billion of Apple stock. In the first quarter of 2024, they reduced their position by approximately 13%. They sold 116 million shares. That sale netted them somewhere north of $20 billion. Now, $20 billion is a monumental sum, but it is not $110 billion. The larger number is closer to the total value of their remaining stake. Why the distortion? Because the media wants to frame this as a story about one company, about Buffett's love affair with Apple cooling off. But this isn't about one company. This is about the entire system. When pressed at the Berkshire Hathaway annual meeting, Buffett gave a politically safe, perfectly logical, and entirely incomplete answer. He said the sale was driven almost exclusively by tax considerations. He stated, and I quote, "If I'm doing it at 21% this year, and we're going to be doing it at a higher percentage later on, I don't think you'll actually mind the fact that we sold a little Apple this year." He is, of course, referring to the potential for corporate tax rates to rise from the current 21% level, a distinct possibility depending on the outcome of the next election. And for 99% of financial commentators, that's where the analysis ends. It's a neat, tidy story. Buffett, the master capital allocator, is simply optimizing his tax burden. It's prudent, it's logical, but it's a surface-level explanation designed for public consumption. Warren Buffett does not make $20 billion capital allocation decisions based on a potential single-digit percentage point change in the corporate tax code. That is the kind of thinking that traps the retail investor in a cycle of reacting to news instead of anticipating trends. The tax reason is the excuse, not the cause. The real cause is a flashing red signal on his dashboard, a signal that has to do with the fundamental valuation of not just Apple, but of the entire US market edifice. To understand why Buffett is really selling, you have to look at Apple not as a beloved consumer brand, but as a financial asset with a price. And that price has become disconnected from its underlying reality. For years, Apple's growth was astronomical, justifying a premium valuation. But what is the reality of 2024? In the first quarter, iPhone sales, the engine of the entire enterprise, fell by 10%. We're seeing intense competition in China from domestic champions like Huawei. The Vision Pro, while technologically impressive, is not the next iPhone. It's a niche product, not a societal game changer. There is no clear next-generation growth driver on the horizon that can justify a forward price-to-earnings ratio that hovers near 30. Historically, Apple has traded closer to a PE of 15 or 20. Buffett, a student of Benjamin Graham, lives and breathes the concept of margin of safety. He buys wonderful companies at a fair price. The question he is now asking himself is Apple still a fairly priced asset? Or is it a wonderful company at a dangerously speculative price? Selling a 13% stake is his answer. It's a disciplined, methodical reduction of risk. He isn't dumping the whole position because he still believes in the long-term power of the company's ecosystem and its prodigious share buybacks. But he is trimming. He's taking profits. He's reducing his exposure at what he likely perceives to be the top of a cycle. He is selling his shares to a market that is still euphoric, a market happy to pay 30 times earnings, for slowing growth. He is being fearful while others are greedy. This leads to the second, more terrifying part of the warning. Apple is not an isolated case. It is merely the largest and most visible component of a systemic problem: extreme market concentration. The entire rally of the past 18 months, the narrative of a strong market, is a fraud. It's not a strong market. It's a strong 7 stocks, the Magnificent 7. As of early 2024, these 7 mega-cap technology companies, Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla, accounted for nearly 30% of the S&P 500's total market capitalization. Think about that. 7 companies are dictating the performance of the entire index that represents the American economy. This is the very definition of systemic risk. It means the diversification that the average retail investor believes they have by buying an S&P 500 index fund is an illusion. They are not buying a basket of 500 companies. They are making a massively levered bet on a handful of tech stocks trading at nosebleed valuations. When Warren Buffett sells $20 billion of the largest component of that index, he isn't just trimming Apple. He is making a statement about the stability of the entire structure. He sees a house of cards built on 7 pillars, and he just pulled a significant amount of his capital out of the largest, most foundational pillar. He is signaling that the risk of contagion is unacceptably high. If Apple, with its slowing growth, begins to see its multiple contract back to historical norms, the ripple effect on the Magnificent 7, and thus the entire S&P 500, would be catastrophic. Now let's zoom out further, because the decisions at Berkshire Hathaway are not made in a vacuum. They are made against a macroeconomic backdrop that is more precarious than at any point since 2008. This is the final piece of the puzzle, the reason the warning points specifically to a 2025 crash. For over a decade, the market was fueled by a simple, powerful drug: 0% interest rates and quantitative easing. The Federal Reserve was pumping trillions of dollars of liquidity into the system, forcing investors into riskier assets like stocks to find any semblance of a return. That era is definitively over. We are now in a regime of quantitative tightening. The Fed is pulling liquidity out of the system. Interest rates are higher for longer. This isn't just a catchphrase. It is a fundamental rewriting of financial gravity. A 5% risk-free return on a treasury bill changes everything. It forces a reassessment of every other asset price, especially growth stocks valued on the promise of distant future earnings. Those future earnings are now discounted at a much higher rate, making their present value significantly lower. Buffett sees this. He is a master of insurance, of assessing long-tail risk, and he sees the macro risks piling up. He sees a US national debt careening past $34 trillion. He sees a persistent inflation that the Federal Reserve is struggling to contain without breaking the economy. He sees the inverted yield curve, the most reliable recession indicator in modern history, which has been flashing red for the longest period ever recorded. And what is his response? It's not just selling $20 billion of Apple. His true action, the one that screams danger, is hoarding cash. As of the end of the first quarter of 2024, Berkshire Hathaway is sitting on a record $189 billion in cash and short-term treasuries. Let me repeat that. $189 billion. That is not an offensive posture. That is the ultimate defensive crouch. That is an investor who sees deep systemic risk across the board and finds virtually no asset attractively priced enough to deploy his capital. He is deliberately choosing to accept a lower return on cash because he believes the risk of principal loss in the broader market is too high. He is building a war chest to deploy after the coming storm, after the market crash. So let's put it all together. The media sells you a story about a tax-motivated trim of Apple stock. The reality is a multi-layered warning from the most successful investor in history. Layer 1, the largest, most important company in the world, is fundamentally overvalued for its current growth prospects. Layer 2. The entire market structure is dangerously concentrated in a handful of similarly overvalued stocks, creating unprecedented systemic risk. Layer 3. The macroeconomic tailwinds of easy money have reversed into hurricane-force headwinds of quantitative tightening and suffocating debt. The Apple sale isn't the story. The record cash pile is the story. It is the clearest signal Buffett could possibly send. He is preparing for a future where asset prices are dramatically lower. He is preparing for the unwinding of the Magnificent Seven bubble. He is preparing for the consequences of the most aggressive Federal Reserve tightening cycle in 40 years to finally bite the real economy. He is preparing for 2025. The insiders, the smart money, the oracles, are quietly getting their houses in order. They are selling into the greed of the retail investor. They are building their bunkers of cash. They are telling you, through their actions, not their words, that the party is over. The only question is, are you listening?